These are some boring businesses that you probably skipped past. So in today's video, I'll be covering the boring businesses, Alibaba Stock, as well as some questions left in the comment section below. So let's talk about your amazing boring businesses first. And here is how I'm going to choose them. I'll be choosing the non-tech companies that are compounding machines, and I'll choose companies with strong fundamentals with recurring revenues to fall back on as well. And the first company that I'll be talking about is this company called Waste Connections. So Waste Connection is similar to Waste Management in the US itself, but it operates in Canada. So this stock over the past 5 years is up around 95%. It is currently trading at a 74 times earnings. So this company has an amazing moat because the company has recurring revenue coming in every single year. And even in any sort of economic environment, people will still have to get their waste basically cleaned up. And this company has high barriers to entry as well because of the amount of landfills that they have nationwide. So they have more than 100 landfills in Canada itself, and competitors actually pay Waste Connections to dump their waste at all these landfills. And for Waste Connections, their customers, they can't really switch as well because they're locked up by contractual agreements with auto renewables inside as well. So if you're to look at the growth rate of the company itself, the growth rate is just stellar. This is a company that is growing at 5-10% almost every single year in any sort of economic environment. And it is a recession resistant company as well that will keep growing in any sort of environment. Because even when a recession comes, people will still have to pay to clear up the trash. So another company that is similar to Waste Connection is Waste Management in US itself. And over the past 5 years, this company has returned 116%. It looks like an extremely boring business, but the performance of the stock price as well as the fundamentals itself are quite remarkable. So for your waste companies, they're often overlooked by Wall Street investors because they're not exciting. So for all these companies, they have sort of like a geographical monopoly as well because it doesn't make sense for a competitor to come in and steal share because it won't be profitable for them as well. And for these companies, they have highly predictable recurring streams of revenue coming in every single year with decent pricing power as well because they have the ability to increase the prices of their services without pullback from their consumers because it is all auto renewable in the contractual agreement itself. So waste companies, they are highly predictable businesses that you should be looking at. I've been looking at these companies, but they're trading at too high a valuation for me to want to be interested in them. Next set of companies will be your lift companies. So this company, Otis, is up around 7% year to date. It is currently trading at a 26 times earnings, giving you a 1.6% dividend yield. So why are your lift companies amazing? So for your lift companies, they have a growing installed base, leading to strong recurring revenues for the company itself. Because for all this installed base, they will have to be serviced by the company that created all these lifts itself. And they have decent pricing power as well because customers are unable to switch to alternatives because the lifts, they are made by Otis, and only Otis personnel will be able to service the lifts itself. So for example, a company like Otis has more than 80% of its net income and profits coming in from services itself, and the services portion has been resilient even during poor economic environments. So for the services portion, they've been able to increase volume, increase pricing, increase productivity as well, which is quite amazing for this company. And if you were to look into the metrics of Otis as well, it's just stellar. So they have ROIC of 48%, ROCE of 17%, ROA of 13%. The ROIC and ROCE are just amazing for any single company. And for all your lift companies, they derive a lot of their revenue from China itself. China was the fastest grower in this segment. But with the China housing crash, it led to a lot of these companies experiencing slower growth and even declining growth because the new housing builds went down drastically, leading to less lifts being built as well. So we could see a recovery soon in your Chinese market, and if you're to see that recovery in the Chinese market, then a lot of your lift companies here, they will drastically benefit from that situation as well. So we have to see how this one plays out, but I think your lift companies are highly predictable, recurring revenue businesses that I would like to own in the future as well. Next set of stocks will be your hotel companies. So for example, a company like Marriott is up around 218% over the past 5 years. So for your Marriott and all your different other hotel companies, they have a highly predictable business because they have the franchise portion of the business, which is basically just recurring streams of 100% operating margin business. So for example, Marriott has around 75% that is franchised, Hilton has 87% franchise, Hyatt has around 80% franchise as well. So your franchise portion, it is incredibly high margin. Although hotel operations isn't a very good business model, they have the franchise portion to supplement to it, and for their franchising portion, what they're doing is they're basically licensing their names and collecting 100% operating margin of profit for the business itself. So it's extremely high margin and high profit for these companies. And for hotel companies like, for example, Marriott, the metrics are quite incredible as well. So ROIC of 20%, ROCE of 21%. It is similar to a company like Otis, high ROIC, So I would love to own these businesses in the future, but of course there's a risk to these companies. If we see an economic downturn, the first few portions that will be hit is your travel, and that is what we saw in 2020 as well, especially when the pandemic came. So for these companies, I view them as highly predictable businesses with recurring streams of revenue coming in. So I would love to own them in the future. Let's see if they get to a decent valuation for me to think about entering into them. Next portion, I'll be talking about Alibaba stock. So Alibaba in the past month is down around 7%. It is currently trading at a 14 times earnings. But is Alibaba as cheap as it seems? So for Alibaba, if you're to look into their income statement itself, as well as the annual report, there's this portion of the income that is a one-time thing. So they have the interest and investment income, which is around 20 billion yuan. So if you're to adjust for that, the company is actually trading at around 18 to 20 times earnings, instead of the 14 times that we saw in the previous slide. So Alibaba is a company that is cheap, but it is not super cheap. The company is heavily reinvesting into cloud and commerce. The last time they did that, the management failed drastically, and that led to the sacking of the CEO, which is Daniel Zhang. He resigned, but he was likely kicked out of the company because of poor performance. So there's another bad thesis for Alibaba as well, which is their reduced market share. So the e-commerce portion in China itself is facing a lot of competitors. So for example, you have companies like Douyin, Kuaishou coming up as well. And for Alibaba, the market share has been steadily declining over the past 6 years or so. The company now has around 39% of the entire e-commerce market share in China. But for the shrinking market share, there's a counter argument to it as well, which is that Alibaba is chasing out all the low quality sellers, and all those low quality sellers, they're flooding to companies like Pinduoduo, like JD for example. So for Alibaba, it still holds a significant share in your retail segment in e-commerce. So for Alibaba, here are some of the bull case for the company. So the first bull case is simply just the Chinese economic recovery as well as a wildcard on AI growth in China. If Baba is able to defend their market share in e-commerce and expand their margins as well through price hikes, then you could definitely see this company growing EPS at upwards of 10-15% over the next few years. And they've been doing so as well. So the operating margin has increased from around 12% in 2022, which was the low point, to around 15% today. So the company has not only been able to increase its revenue itself, it has also been able to increase its operational efficiency and increase operating leverage as well, because the company has not only been able to reduce the amount of cost as a percentage of the revenue, the company has also been increasing the prices and the commissions on the platform itself. So for Alibaba, it is a stock that is interesting today. I'm actively looking into this one. The company is not as cheap as it looks, but it is definitely a quality business in China with a clear tailwind for the business itself. Next portion, I'll be talking about some questions left in the comment section below. So the first one, it says, as a Singaporean investor, does it make sense to own US dividend stocks? Given that dividends are subjected to 30% withholding tax, wouldn't it make more sense to focus on quality SG or Hong Kong listed dividend companies? So I agree with this. In US itself, you have to pay a 30% withholding tax, which will hurt your income as well. But the problem is your US stocks are typically higher quality as compared to your Singapore stocks, as well as your Hong Kong stocks. So yes, if you're thinking of holding dividend stocks, I think the better approach is to buy your Singapore as well as your Hong Kong stocks. In Singapore, you can buy the REITs here. In Hong Kong, they have a lot of dividend yielding companies as well with zero withholding tax. So avoid the US stocks if you want a dividend portfolio. But of course, if you're chasing capital gains, then the US stocks, they are much higher quality as compared to your Singapore or your Hong Kong stocks. Next question, it says, hi, what are your thoughts on Oracle stock? So Oracle is actually a stock that is up 42% year to date. It is drastically outperforming the S&P 500, and it is currently trading at a 54 times earnings. So for Oracle, they are a CRM business as well as a cloud business itself. And for Oracle, they derive a substantial amount of their revenues from the cloud portion of the business. But I think in the cloud segment, the best way to participate in it is to simply buy the three hyperscalers at the top. So AWS, Azure, as well as Google Cloud. I think the players at the bottom, they don't have the resources that all three companies up there have, because the three companies up there can burn hundreds of billions of dollars every single year, which the other companies can't afford to do, because all the businesses at the bottom, they don't have a Google search, they don't have a Microsoft 365 to continually print cash for the business to burn in the cloud segment. So if I'm looking for a cloud company, I think the best cloud play is to simply just invest in the top three companies up there. They are the top three for a reason, and Google, for example, is growing drastically. Azure is also growing drastically, so I don't see them going anywhere in the future. I hope you guys have found this one useful and invest safe.